Okay, so good morning, everyone. I'm Astrid. I am the lecturer from the Pretoria campus. So in today's session, we're going to start off with taxable income basics. So we're going to split this in two sessions. So the other session will be on Thursday because of the fact that taxable income is in essence your tax framework, which you use to work out what is the taxable income of an entity. So what is basically their net profit that they will be taxed on. That is what we're calculating. Now, in today's session, we're going to focus more just on the gross income as well as the exempt income linked into that. And then in the following session, we'll then focus more on the expenditure and the deductions you are allowed to have. If you have any questions, please raise your hand or just type a question into the chat function and I'll address it as we go along. If I'm going too fast, please tell me, then I'll slow down and repeat something. If there's something that you're wondering about or it's unclear, just let me know and I can repeat it or I can re-clarify it. The aim of today's session is to help you guys, especially the guys that are repeating, to make sure that your foundation is solid so that you can get that 50% that you are aiming for to pass the subject. Now, taxable income is a big section in tax, as that is what most people pay tax on, especially if you're a salary earner, if you're a company, if you're a partnership, if you run your own small business, you will generally pay this type of tax. So aside from that, this is the second largest tax that SARS normally then collects in a year's time. Okay, so let's quickly see what are we going to focus on today. So we're going to start off with the different taxpayers. I'm just going to mention the different taxpayers and how their taxes would be calculated differently. Now, your textbooks that you guys are using focuses more on business activities, but because of the fact that a sole proprietor is an individual with a business, there are one or two additional exemptions which I'm going to just mention, which is not covered in this textbook, but which they can still ask you because of the fact of how a sole proprietor works. Then we're going to talk about the tax framework. So this is your sort of your indication of how to do the calculation. That is your guide. So it's normally if you have that set out, written down, you can just slot in the information when you answer a question if you have to do a calculation. So we're going to focus on the gross income and the exempt income specifically in that framework today, and then we'll focus on the other aspects in a different session. Now, the gross income is the foundation. So that's basically what is included as income in our tax calculation. Now, generally, it is any income you earn depending on whether you are a South African taxpayer, a resident taxpayer, or non-resident will influence what type of income you would include there. And the main thing with gross income, it excludes amounts of a capital nature. Now, the reason for that is because we will include those amounts in your taxable capital gains calculation, any profits that you made on capital items. So that's why it's specifically excluded from gross income. And then we'll look at the exempt income. So that is income that has been included in your gross income based on the definition or specific inclusions. But then SARS says, okay, for these ones, we'll give you some leniency, we'll give you an exemption for those specific ones. Okay, so that is what we're going to look at today. The session will be recorded. I will share the link for the session as well as the slides after the session with your lecturers, and I'll ask them to distribute it to you. Okay, what I can also do is at the end, I can just give you my email address so that in the event that you guys don't get the recordings or the information from your lecturer, you can just contact me and I'll just share the information with you. Okay, so the first thing we're going to look at today is the different taxpayers. Now, as you can see, we've got a sole trader. It's also a sole proprietor. Those are individuals that run small businesses, but in their personal capacity. They have not registered it as a company or a PTY limited or closed corporation. So that is where you, for example, run a law practice, accounting practice from your home in your own name. Now, for tax purposes, as a sole trader, what it means is because I'm running a business, I can still get the business deduction from the income that I've earned from running my business. Whereas as an employee or salary earner, I would not be allowed the benefit of getting that deduction. So I would generally only be allowed to get a pension fund deduction if I'm a salary earner and then the medical aid credits. Whereas a sole trader, if I pay electricity, I pay rent, printing, I pay for accounting package, whatever the case may be, I can get those deductions and then only pay tax on the net profit that I made from my business. Then a partnership is where you have a group of individuals. It's generally about 2 to 20 individuals that runs a partnership together. Now, based on what they contribute, they can either contribute their skills or capital. They get a certain percentage in that partnership. And then the profits are generally split accordingly. Now, with a partnership, you are taxed as an individual, so it gets taxed in the hand of the individuals and not in the partnership. So you first go calculate the profit for the partnership, then go divide it between the individuals, and then because it goes to the individuals, then they get the additional exemptions like your interest exemption, which an individual gets but a company won't get. They can claim that individual exemption as well as then the additional deductions for the partnership that they would have been allowed to claim. So that's how a partnership works. But according to your module outline, partnerships are scoped out for this year, but you just need to be aware of the fact that there are partnerships and how they are taxed. Then closed corporations as well as companies are all taxed at 28% unless it is a SBC, which is a small business corporation. They have a specific tax table for those ones. That is generally small businesses that earns under 20 million of turnover and meet specific requirements. Now for your SBCs, there are specific things that you need to be aware of. But in a question, they okay, so for the SPC, some of them have in the question, they will generally tell you it's a SPC unless they want you to motivate whether it is a small business corporation. Then they will actually give you the information and you need to document that. Okay, then for the company, it's also 28%, and SPC, and then trusts are normally at 41%. Okay, so those are the different tax rates that apply. Now, the way you calculate the taxable income for a company, whether it's a closed corporation, whether it's a company, whether it's a trust, whether it's a small business corporation, that will be exactly the same. It's only going to be the tax rate that will vary. Okay, I see there's two comments coming through, but it's not popping up in my chat function. Let me just open that up again and see if it wants to show. Okay, it's not showing up on my side. Can whoever posted their comment just quickly put on your mic so I can just answer your question for you? Okay, can someone maybe just repost what the last two comments were? I can see these comments, but I can't see what the comment was. It's not reflecting on my screen at the moment. Okay, so Taboko, for the as I am aware, some of you have heard your classes. We do record all of these sessions, and I will make the YouTube links where I posted available so that you can watch it later. Ipeleng, I saw the comment was on my personal one. It wasn't on the group chat. That's why I didn't see it. So just to so that everyone knows, what we'll do is we are recording these sessions. I will send the slides to the lecturers as well so that you guys can get the information for in case you can't attend the class. So don't worry about it if you need to pop out for your actual classes. Okay. So those are the 4 or the 5 different types of taxpayers that you would see. Now, the ones that would generally ask you in a test would either be a closed corporation or company. So closed corporations actually fell away. So it's mainly companies. You treat them all the same. And then they can potentially ask you the sole trader as well. Okay, I'm just quickly going to put my email address for you guys in the chat function. If you want to write it down, then you can just contact me if you don't get the information from your lecturer. Okay, so let's get into what does the tax framework look like. So this is your starting point when you have to do this tax calculation. Now, the reason we set it out this way is it is also to help you structure the question and make it easier for you to drop in the information as you do a question and to make sure that you do not miss anything. It helps jog your memory and also make sure that you get to the correct calculation. So the first thing we have is gross income. So the first one is gross income. That is covered in Learning Unit 4 in your textbooks. Then we've got less the exemptions. So this is your exempt income, which would also be covered under Learning Unit 4 when you do your normal classes. So how it works is your gross income is any income that is specifically included in your tax calculation. Now that is based on whether you are resident or non-resident. There are different rules for the two. So if you are a resident for tax purposes, that means you will be taxed on your worldwide income. Whereas if you're a non-resident, you will only be taxed on income that is from a South African source, so that you've earned in South Africa, either based on the business that is situated here or from selling goods or services specifically. Now, the exemptions or the exempt income, that is based on whatever you've already included in the gross income. So you can only get an exemption or exempt income in the event that you have included that amount in the gross income. So what a lot of students generally forget, and this is also where you lose easy marks, is you would forget to include it in the gross income, but then include it in the exemptions, or you would include it in gross income but forget about the exemption. And then you actually lose a mark or two depending on what it is. Now, some of the exemptions is a full exemption, other ones are partial exemptions. That means they have a limit, and anything over that will be taxed. Now, if you add those two together, you get income. So if they ask you in a question to calculate the income, that means it is gross income less the exempt income portion will give you the income. Then after you've calculated the income amount, then you get deductions. Now that deductions are generally broken up in your general deductions and then your capital allowances. So I've just split them up here for you, but they are broken up in those two categories. Now your general deductions and your capital allowances we'll discuss in the next session we're having on Thursday, but those are based on your general deduction rule, which says as long as that deduction is in carrying on your enterprise and for your business and it's not specifically excluded, you can then deduct it from the income that you've earned. But it talks about the income. So if that expense relates to something that is exempt, that means there's no income that you've earned. So you've included the gross income, you've included the exemption, and then the amount is zero. So the income from that is zero, then you would not be allowed the deduction. And then capital allowances are your deductions for your assets that you use in your business, for example, your motor vehicles, your office furniture, your buildings. So those type of long-term assets which you use in the business to generate income, you then get additional deductions, which we call capital allowances. And then we said in the gross income that excludes amount of a capital nature. And the reason for that is because we add all the capital amounts, the profits that you've made on that under your taxable capital gains category. And that is why they are specifically excluded from gross income. Now, then you work out the subtotal before you can work out, we call it the section 18A, which is your donations deduction, and that is limited to 10% of your subtotal. So that's why it's important to follow the framework so that you are able to work out the deduction limitation in a question. So normally what we will do is we will give you a deduction that is more than 10% so that you have to limit it to whatever that is. If it is less than that, you can deduct the full amount. And then you work out the taxable income. So that is, in essence, what your company's profit is under tax purposes. Now, once you've calculated your taxable income, then the next step is to work out the net tax payable or refundable. Okay, so you start with the taxable income. Now, this is also where a lot of students go wrong, is they forget this little step where you apply the percentage and then they just use this full amount as their amount to work out their tax liability. So we said for a company it's 28%, for a trust it would be 41%, but for a small business corporation it would be a sliding scale. Now that sliding scale they will provide for you as an annexure in a test or in an exam. So you then go look at what category it's falling under and then apply that. So the one question we're going to look at today, which is a sole proprietor, also uses a sliding scale so that we can just focus on how do you actually apply the sliding scale and how does it work. Then we deduct the provisional tax. So that is the tax that your company has prepaid already during the year. So for companies, we have two provisional tax payments. They happen every 6 months. So the first 6 months of the year, and then at the end of the financial period, you'll do a second payment. And depending on how you did the calculation, you can do a top-up payment to avoid penalties and interest. So we deduct then whatever we've prepaid already from the tax that is due, and then we work out what is the normal tax due to a taxpayer, and then we add withholding tax. Now withholding tax is the in this case it's the 15% that we've withheld from the dividends that it was paid out from a company to an individual or to a company. The company that's paying the dividends normally have to withhold the tax before they pay out the amount, and that is then added here to show what is your actual tax that you need to pay over to SARS. And that's how you get to the total tax liability. Okay, so before we move on to gross income, do you guys have any questions on the tax framework or the net tax payable refundable slide? Okay, so when we talk about gross income is basically any income a person earned during that tax year. But now you have to look at whether, I said, what is important, are we looking at a resident or are we looking at a non-resident? And the reason for this is because what type of income would be included in your calculation. Now, if they tell you it's a resident or non-resident, there's a reason for this. They will include sources in your question that might be relevant or not relevant. And if you've missed this, you can then accidentally include something that's not supposed to be included in your calculation. Okay, if they do not tell you anything about this in your question, then you can assume it is a resident company and you include all the income, all the worldwide income, as opposed to just South African sources of income. But if they specifically tell you it's a non-resident, then be mindful of what income you would have to include. Now, when we talk about a person for gross income, it includes all natural as well as juristic persons. So that means individuals or a company or a CC or a trust. It doesn't matter. It includes everyone. So anyone that earns income will have to pay tax. I know there are people that don't pay tax, but some of them are supposed to. So that's a whole different story. Now, when we look at what the Income Tax Act defines as gross income, so I'm going to start with what is a resident's income versus what is a non-resident. So gross income is for the period or the year of assessment. So that is normally for a 12-month period, unless the company started during the year, then it would only be for the period from inception until the year end. So sometimes the company would start during the year, and then the year end would not have been 12 months after, it would only be 5 or 6 months later. So then you would only be taxed on those 6 months. Now the year ends for different taxpayers vary. So for an individual, for a partnership, your tax year end, as well as for a small business corporation, your tax year end is the end of February. Whereas for a company or trust, your year end is when the company or trust decides they want their year end to be. So that can be February if they want to align with the tax periods. It can be June, it can be December. So it would differ for a company and trust specifically. Now, if we've got a resident, what you will see, it is the total amount in cash or otherwise. So the reason they included in cash or otherwise, sometimes what would happen is a company or an individual would not have cash to make a payment, so they would either provide you with a service that you require as a payment, or they would give you some form of asset, for example, a computer or laptop that you might need. So what SARS did is initially it only said amounts in cash, and then people started paying in goods and services. And that is how they closed the loophole by saying in cash or otherwise. So it means whether you receive it in cash or whether you receive a goods or service in return for that, you will be taxed on the value. And then it's received by or accrued to or in favor of such a resident. So I physically received it. Accrued to means I have already delivered the goods or service, so I am entitled to receive that amount. And in favor of is a third party has collected it on my behalf and they will pay it over. So once any of those three items occur, I will be taxed on that amount. And then very important, it excludes receipts or accruals of a capital nature because of the fact that they will be included under your taxable capital gains calculations. Now, for a non-resident, you will see the difference is it is from a source within the Republic. So that is the Republic of South Africa. So it's from a South African source will be included. So that is the only difference in the definition between a resident and a non-resident. So you'll see for a resident, they do not specify, which means it is based on their worldwide income. So whether they earn income locally or overseas, they will be taxed on it in South Africa. Whereas a non-resident, that's generally your foreigners that runs a business here or earns a salary for a certain part of the year, they will only be taxed on what they've earned in South Africa because they are taxed in their own country on their foreign income. Okay, so we are going to focus now on the first item, the gross income of the tax framework. Okay, so this is what we're going to look at now. So when you get a question regarding if something should be included in gross income or not, you have to go look at the different components. So I'm going to discuss each of the components now, and in some of the cases also referred to the case law. In your tax workbook that they've loaded onto the system for you guys, they have listed some of the main tax court cases relating to these specific areas, and you need to know them for any theory type of question because they can actually ask it. So the components that gross income is specifically made up of. The first thing is you look at whether it's a resident. If it's a resident, then we have the total amount in cash or otherwise received by or accrued to. That's the next category. We look at what is the year of assessment or the period of assessment. Now, why that's important is something that is accrued or received might fall into the one tax year and then another amount in the following tax period. So it's very important to know which tax period are we busy with to assess whether I'm going to be taxed in the current year or in the following year on that amount. And then other than accruals or receipts of a capital nature. So anything that is accrued or received in that tax period but is not capital of nature. Okay, so for residents, to be a resident in South Africa, there is two tests that is followed. So the first one for individuals, they are either ordinary residents, so that means they spend most of their time in South Africa. Now there's a specific number of days, so for the current year, you need to be in South Africa for more than 91 days, and then over a 5-year period, consecutive periods, you've been in the country for more than 91 days, and then for more than that 5-year, then they do the consolidated, which is about 800 and something days, and then you are ordinary resident in the country. Whereas for a juristic person, so that's a company or a trust, they look at where it's effectively managed. Okay, now effectively managed, that is where the day-to-day activities occur, where all the decisions occur within the company, that if it occurs in South Africa, then it is seen as if it is a South African company, and then it will be taxed on its worldwide income. You can also look at where it has been incorporated, established, or formed as further indicators of whether that company is a resident or not. Now, the two tests for a natural person is your ordinary resident test and your physical presence test. So ordinary resident test is where you generally stay, where you would return after holidays. That is where you are ordinary resident. So that is where I would live, where I would carry on business, where would I generally be if I'm not on vacation, if I'm not visiting someone, where would I generally carry on trade? Whereas the physical presence test is for what period of time am I physically in South Africa? So that is generally more for people like your flight attendants, people that work on ships, or contract workers that would work in different countries. You would use the physical presence test to establish where they are resident for tax purposes. Whereas with the rest of us, we would generally fall under the ordinary residence test. Now, there are specific case law which also gives you some further information regarding that. So let's look at the first category, your total amount in cash or otherwise. Now, what we say that means is the value of the asset received instead of the cash is included in your gross income. So if I receive, for example, a laptop from my supplier, I will include the laptop in my gross income. But the question is, what amount would I generally include? Now, you would generally use the market value of that asset that you receive when you include it in the question. Now, they say an amount has a wide meaning, and that is based on the Latergan case, and that it should form part of your taxpayer's property because it still has a monetary value. So even if I didn't use that laptop, I could sell it and then get money for it. So that's the rationale behind it. Now, when we look at receipt or accrued, amounts that are received is only received if there's no condition linked to it that that money needs to be repaid. So it's unconditional. Okay, but what is very important with the received amount? If there is a condition to repay it, I need to keep it in a separate trust account. So something that is in the name of the person that I have to repay it. So let's take, for example, a deposit for a property. I would have to keep it in a separate trust account. Otherwise, even though I still have to potentially repay it, I already have access to that money. So I would have actually received it, whether it was for my behalf or not. So that is one of the things they like to ask is the deposits specifically. Okay, so Geldenay said it needs to be received by the taxpayer or on his own behalf and for his own benefit. So if you receive money, but it's not for your behalf and it's not for your benefit. So I receive money as an agent that I pay over to a third party. The agent will not be taxed on that money. The third party that they're paying it over to would have to include it in their gross income because it's an amount that is for their benefit. Okay, so if you see something like an agent that collects money on behalf of a property owner, then the rent that they've collected would be for the benefit of your property owner, but the commission that they've earned would then be for the agent. Okay, and if there's any condition linked to that money before it will be for their behalf, that condition, once it is met, then you would have received it. Whereas accrued means, according to People's Stores, it is when you become entitled to that amount. So as soon as you've delivered the goods or services, you are entitled to that money. And if there's a conditional entitlement, it would not constitute an accrual until that condition is met, and that is based on the Moyes versus Sir court case. Now, what is very important with receipts or accrual is we ignore the time value of money. So even if we receive something for a period that will happen in 12 months or after 12 months, we do not take the time value of money into consideration. We take the amount as received. Okay. And the general tax rule is you are taxed on the earlier of receipt or accrual. So whichever is occurs first, that is the tax period that you would be taxed on. So if it accrues to me before I received it, I will be taxed when it accrued, but I will not be taxed again when I receive that money. So that is important to remember. Now, I've just summarized some of the court cases specifically linking in with the meaning of received. The major ones is the Pied one that says if a deposit is not placed in a separate trust account, then it will be taxable. But if it is in a separate trust account and I do not have access to that money, only the person whose name it is in, then I will not be taxed on that money until I withdraw it from that trust account. Then we've got our Witwatersrand and Racing Club's case, where they said once an amount has been beneficially received by or accrued to a taxpayer, that amount is taxed even though the taxpayer might still have an obligation to pay it over to another person at a later stage. Okay, so once you've received it, then you will be taxed on it. Then the MP Finance Group one, it doesn't matter what type of source of income it is, whether it's from illegal receipts or ill-gotten gains, you will still be taxed on that amount, even if you stole the money. It is considered a receipt in terms of gross income tax rules. And then Dalgoa Bay Cigarettes says that an amount is income irrespective of the activity. So it's similar to the MP Finance case. So those are the two court cases which said that it doesn't matter if it's ill-gotten gains, if you stole it, or if it's illegal activities, you will actually be taxed on it, or if it is immoral. But what the Dalgoa Bay one said is, okay, fine, if I'm taxed on the income, then I should also be able to claim the expenses that I've incurred in generating that income. So those are quite interesting court cases relating to amounts received. Now, when we look at the year or period of assessment, that is the tax term for our financial year specifically. Now, what we said is for juristic persons, they can choose it, whereas individuals, partnerships, and micro businesses, their year end is end of Feb. And for a micro business, so that's someone that pays turnover tax, they have a taxable turnover of less than $1 million per year. We do not work out gross income for them because they are taxed on their turnover, which is basically just their receipts, their turnover for the year, and then we do an adjustment for capital receipts, 50% of that, and then that amount is taxed using a sliding scale. And then any amount that is accrued or received is included in that year of assessment. Now, when we talk about receipts of a capital nature, you have to think about the tree and the fruit principle. So a tree would be seen as capital because of the fact that you will use it for a long period of time, whereas the fruit of the tree would be seen as income because of the fact that I will receive income from it every year. So it's not over a long period of time and it won't generate future income. So let's take, for example, we've got an apple tree. The trees will be capital in that apple tree company because of the fact that we are going to keep it for a number of years to produce apples, whereas the apples, we will sell them after every season that we've harvested them. So that is what CRR and FIS's court case said. Okay, so that is the tree and fruit principle. Okay, so because of the fact that the capital nature can vary from one business to another business. So in one company, something would be capital, but in another company, it would, for example, be income. There is two types of tests that you can use to determine if something is capital nature or not. So we've got the subjective test and the objective test. Now, if we look at the subjective test, you have to look at what was the intent of the taxpayer when they initially got that asset. So did they buy it to use it for a long period of time, which is then seen as capital in nature, or have I bought it to generate profit or in a profit-making scheme? So that is the first thing you have to look at. What was the intention when I bought it at acquisition? Now, that intention can also change over a period of time, so you also need to take that into consideration. And then they also say that if you look at the Pick and Pay employee share trust ones, that the proceeds on a sale of an asset will only be taxable on the realization if it was for a profit-making scheme. Then you would include it in your gross income. Otherwise, it would when you sell it be included in your capital gains. And then based on the Scott case, they said the mere fact that you are going to sell an asset doesn't mean you've changed your intention. So let's say I've acquired shares initially and I wanted to keep it for long-term, for growth purposes. Then my initial intention is capital in nature. But now what happens is something happened in the market and these shares are losing quite a lot of their value, or they've increased significantly in value and I need money to finance something else, then I can sell it and it will still be capital in nature, irrespective of the fact that I'm selling it now. Okay, and then John Bell said something more is required in order to determine if something is gross income or not. So you can't just look at the fact that they've bought it or sold it there. You have to look at other factors as well to determine whether it's capital or not. Then if we look at the Milan one, they said the court generally have to give consideration first of the taxpayer's evidence, and the taxpayer is liable to motivate what was their intention. So the court can, or SARS can decide that it is gross income, and then it's the taxpayers has to motivate and substantiate why it was not gross income and why it was capital. So they have to provide the burden of proof. And enrichment, they said the intention of the company would be the intention of the directors. So if the directors bought something for a profit-making scheme scenario, then they assume that that is the same intention of the company as well. Then if we look at Cott versus Levy, where there's a mixed intention, the dominant one will prevail. So that is where you have to motivate which is the most dominant of the two. And then if we look at Natal Estates, that is where your intention changed. So initially you bought it for capital purpose, but then later on it changes. Then you need to, once that crossing happens, then you have to account for it as gross income. Where we look at objective, we look at specific types of facts to indicate whether it's capital or not. So you look at the manner of the acquisition, the manner of disposal, how long did they keep the asset for, was it held for continuity, what's the taxpayer's occupation, the nature of the asset disposed of, the reason for the receipt, the operation of the business, their nature of the taxpayer, the activities. So these type of things would also indicate whether the company or the individual bought it for a capital purpose or for a profit-making scheme. Okay, so this one is more facts-based, whereas the other one is a bit more subjective. It will be based on how the tax court and the individual or company interprets the court cases and motivates the documents they have. Now, when we have receipts of capital natures, the ones that they generally put into the questions is damages and compensation, fortuitous gains, like for example, gifts, if you've inherited money, prizes, donations, and gambling. Now, you have to look at the intention of the taxpayer. Gambling is generally seen as capital in nature. However, if you are a compulsive gambler, so you regularly gamble, then it is seen as a profit-making scheme because that is your intent. Similar with gifts and prizes. If you win prizes quite often because you always enter competitions, then it would also be seen more as profit-making rather than capital in nature. So it also depends on how often that transaction occurs. Doesn't mean if it happens more than once that it is not capital in nature, but that is things that you have to consider and motivate why. Okay, so let's look at an illustrative example. So we say Flynn Ryder is a top salesman at Castle Rock Limited. To incentivize these sales, the company introduced a competition among the sales staff. Whoever the first person is to reach 1 million in sales will receive a BMW. As expected, Flynn is the first person to reach the sales target. So on 15 February, the target is reached and the company orders the car with all the extras that was approved. The car is worth 350,000. The company receives it on the 25th of February and gives it to Flynn at a formal graduatory function on the 12th of March. Okay, so what you can see here is he received the car, so he didn't receive cash, and he met his targets on the 15th. The company received the car on the 25th, but they only handed it over to Flynn on the 12th of March. So there's various dates. So now the question is, does the price actually constitute gross income? Now in a test or question, you will have to go split it into the different components. So if we look at the first component, total amount in cash or otherwise. Although it was not cash that was received, the monetary value of the car, we know it's 350,000. So because it has a value that is attributed to that, that is the amount that you would include. Now received by accrued. Now we have to look at what is the earlier of the two dates. Now, Flynn only became unconditionally entitled to the prize once the sales targets was reached, which was on the 15th of February. The condition was that he made a sales of 1 million by that date. The fact that he only received the prize on the 12th of March is actually irrelevant because it already accrued to him on the 15th of February. So for that reason, he is taxed on the earlier of the two dates. So he would include it in the tax period up to 15 February and not when he actually received it. So you only include it at the earlier of the two dates. Now the year of assessment, as he's an individual, his year of assessment would run from 1 March to 28 February. So that means because the prize already accrued to him 15 February 2021, you would include it in the 2021 year of assessment and not in the 2022 year of assessment. Okay, based on that principle that we've already included, and then we look at, do we have to exclude an amount because it's capital nature? So even though a car is seen as a capital asset, the receipt was based on services he's rendered, which is part of his employment. And that services rendered due to employment is not capital in nature. So therefore, that amount is then not capital in nature. Okay. And is then, it's also not a fortuitous, it can be seen as a fortuitous gain, which is also normally capital in nature, but because he earned it as part of employment, those two rules would then not be used, because we look at why did he actually receive it. He received it because he delivered a service as part of his employment, which is services rendered, and that is specifically included in gross income, and that is then seen as not capital in nature. Okay, so to conclude, you would include a 350 in Flynn Rider's gross income. Okay, so before we move on, do you have any questions on this? On the gross income and why you should include the car in Flynn's gross income. Do you have any questions on that? Okay, it doesn't look like anyone's got questions, so I'm just going to move on. So what I want you to do for a test, this is how I want you to structure your question. If it's more than 10 marks, you start with the normal definition, you apply each of the components separately, and you state whether it's included in your gross income or not. If the question is less than 10 marks, you skip the definition and you just identify the relevant components, which is applicable, and you discuss those in detail, and then you just mention the other ones briefly. Okay. So that is how you should structure your question based on the mark allocation in a test or in an exam. Okay, so you would do similar than the example we did now, but based on the mark allocation would mean how much detail do you actually put in that question. Now, if we look at gross income, these are specific inclusions. Now, the reason they are specifically included is because these items can be viewed as capital in nature. You need to know this list, because what we do in the questions is we actually give you these items in additional information to see if you know it's a specific inclusion. Now, one of them is services rendered. Now, that excludes fringe benefits because fringe benefits is specifically included on its own. So I've only listed the specific inclusions that relates more to your companies. Then you've got restraints of trade. That is included your lump sum benefits that you receive from insurance companies or payouts from workmen's compensation, then contract of employment, or any money that comes from a contract of employment, lease premiums that you receive from renting out a property, know-how payments, so that if you are knowledgeable in a specific field, then you receive a payment for that by sharing the knowledge. Leasehold improvements, so if I improve the property that I'm renting, the leasehold improvement money would also be included. Then if I sell any assets similar to trading stock, so that is, for example, major assets like trucks and that would be treated similar as trading stock depending on your company. Dividends is specifically included. If you receive a government grant as a company, it's specifically included. If you receive any sporting income, specifically included. If a key man insurance policy is paid out, so one of your directors passed away or gets injured on the job, that would have a payment that is made. Then recruitment is also specifically included. Now that is where I dispose of an asset where I previously were allowed to get a wear and tear allowance. Then when you dispose of that asset, SARS says, okay, whatever you recoup of the wear and tear that you've deducted previously will be included specifically and taxed at a later stage. So how do I calculate that recoupment? I take the cost price of the asset sold, I deduct the wear and tear up to that stage to work out the tax value, which is also your carrying amount, and then I compare it to the lower of your selling price and your cost price to work out what is the recoupment. Okay, but very important, you will never have an amount high. If the sales price is higher than the cost price, you will limit the amount to the original cost price. You will never be taxed on more than what you were allowed to deduct previously. Okay, so let's quickly just see defining income. Income is the amount of the gross income that remains after your exempt income amounts. Okay, so that is important to remember. So if we look at the exempt income, you have your partial and your absolute exemption. So partial means only a bit is going to be exempt. Absolute, the full amount is going to be exempt for tax purposes. Now, if we look at dividends, your local dividends is normally, the full local dividends will generally be exempt, whereas foreign dividends, only a portion will be exempt. Okay, so the first test, the question is, when's the first test? The first test based on the past that I saw was, I think, 18 October, and it will be up to your taxable income, but only the capital allowances section. So it will include VAT, gross income, exempt income. It will include general deductions as well as capital allowances. Government grants are generally exempt as well, the full government grant if it is for NGO in that case. Okay, now here's a list of absolute exemptions. You guys can just go through this list. If you see any of these items, generally the ones that would include your PBO or government institutions, then you know the full amount is exempt. Okay. Then partial exemptions, the one that I've added additionally here is your local interest. Now remember, local interest is only exempt for individuals. So if it's a company, you do not get that exemption. If you're younger than 65 years of age, you get up to 23,800 exemption. If you're older than 65, you get up to 34,500 for an exemption. Local dividends always exempted with a few exceptions. You need to know that list. And then foreign dividends is generally apportioned. Okay, so when you look at dividends, if you see any of these dividends listed here, these will not be exempt. These ones will be taxed because of the fact that the withholding tax would not have been withheld, and therefore they will be taxed normally in the company's hands. So the ones they generally include is the one from a rate or controlled company, and then also they generally include the share-based payments one. Those are generally the two major ones, and then the one from the trust. From the trust would also generally be included. Those are the three you generally see, but normally the rates one is the most common one that we use. Foreign dividends, the partial exemption, you use the ratio. Now I've included the ratio for natural person, a juristic person, which is your CCs as your companies, and the insurers. Now, what you do is you work out your foreign capital amount, and then you multiply it with that ratio to work out the exempt portion. If it is on the left-hand side, any of those items, so if you hold more than 10% of the shares in that company, or it's a foreign controlled company, then it would, that entire foreign dividend would be exempt for the question. Okay, so make sure you know the 4 examples which would be exempt completely, and then the ratio you need to apply. We're going to use an example of this when we look at the question we'll do shortly. Okay, other partial exemptions just to be aware of. Interest for non-residents is fully exempt, but only if they were in South Africa for more than 183 days, then they get the full exemption. And then a tax-free investment, if any amount under 36,000 contributed per annum, the interest earned on that is exempt. You have a maximum of 500,000 contributed per lifetime. And if interest is above that, then you would be penalized and you would be taxed at the higher tax rate of an individual. Okay, so I see you guys are asking about the reweighting. So what it means is test 1 fell away. So you only have test 1, and it says it was for learning unit 1 to 5. Now, how we normally set up the test is the learning units that would have been tested in learning unit 1 and test 1 would then have a lesser weighting in test 2. So I think VAT and gross income was included in the first one. So the second one will probably focus more on the taxable income rather than VAT, but you still need to know everything because we can test everything. So just to answer your question on the test. Okay, so this is just the background on gross income and exempt income. Do you guys have any questions on the theory that we've covered before we do a practical question?